On the morning of November 20th, 2024, a federal indictment was unsealed in Brooklyn, New York. Named in it, Gautam Adani, chairman of a $200 billion Indian conglomerate, one of the richest human beings alive. The charge: orchestrating over $250 million in bribes to Indian government officials, then lying to American investors about it. Within hours, Adani Group stocks hemorrhaged $28 billion in a single trading session. Adani Green Energy, the company at the center of the allegations, cratered 17%. A $600 million bond sale was canceled mid-process. Arrest warrants were issued for Adani and his nephew, Sagar. This wasn't the first time the empire had been rocked. Less than 2 years earlier, a small New York research firm had called the Adani Group the largest con in corporate history and erased $150 billion in market value almost overnight. But even after that storm, the group had climbed back. The question now was different. This wasn't an accusation from a short seller. This was the United States Department of Justice. How does a man born into a middle-class family in Western India build an empire so vast it reshapes the infrastructure of the world's most populous country, and then watch it crack under the weight of the very relationships that built it? Empire building. Gautam Adani was born in 1962 in Ahmedabad, Gujarat. One of 7 children, son of a textile merchant. No elite education, no dynasty. At 16, he dropped out of school, moved to Mumbai, and sorted diamonds for a living. He returned to Gujarat, helped run his brother's plastics factory, and in 1988 founded Adani Exports, later Adani Enterprises. Coal, textiles, metals, nothing glamorous. But Adani had something more valuable than capital: timing. India was liberalizing. Trade barriers fell, and private enterprise was suddenly welcome. Adani positioned himself at the center of what the country needed most: infrastructure. He acquired the Mundra port in 1995, now India's largest private port. A year later, he launched Adani Power, now the country's biggest thermal energy producer. By the 2010s, the group operated 13 ports, 7 airports, power plants, solar farms, and private railroads. Its growth mirrored India's own ambitions, and that was no coincidence. Adani's relationship with Prime Minister Narendra Modi, a fellow Gujarati, gave the conglomerate unmistakable proximity to power. In 2018, when India privatized 6 airports, Adani won all 6 leases with zero aviation experience. By 2022, his fortune hit $145 billion, third richest on Earth, from a diamond sorting table to the same Forbes list as Elon Musk. The kind of story people wanted to believe, and that belief became part of the architecture. Fraud mechanism. Explained clearly, what allegedly happened inside the Adani Group involves 2 interlocking schemes. The first was exposed in January 2023 by Hindenburg Research. After 2 years of investigation, they alleged the Adani family had built a web of offshore shell companies in Mauritius, Cyprus, the UAE, the Caribbean, to secretly hold and trade their own stock. The purpose: create the illusion of outside demand to inflate share prices. Hindenburg called them stock parking vehicles. One entity alone, Monte Rosa Investment Holdings, reportedly controlled $4.5 billion in Adani shares. Think of it like a card game where one player secretly controls multiple hands. Every bet looks independent, but it's all coordinated. The result: share prices that soared 250 to 4,100% between 2020 and 2023, numbers that looked less like infrastructure and more like speculative mania. The second scheme was alleged by U.S. federal prosecutors in November 2024. According to the DOJ and SEC, Gautam and his nephew Sagar Adani orchestrated over $250 million in bribes to Indian officials between 2020 and 2024, securing solar contracts at above-market rates expected to yield $2 billion over 20 years. While this was allegedly in progress, Adani Green raised $750 million from investors, including $175 million from Americans, touting its anti-corruption compliance. Prosecutors say those statements were false. Sagar allegedly tracked bribery details on his personal phone. Gautam reportedly met government officials to advance the scheme directly. This wasn't a rogue employee. According to prosecutors, it came from the top. Red flags. The warning signs had been accumulating. 8 family members sat on a 22-person board. Gautam's brother Rajesh had been charged with running a diamond trading scam using fake offshore companies, then was promoted. His elder brother Vinod appeared in the Panama Papers and was linked to at least 38 Mauritius-based shell entities. The valuations defied gravity. Adani Green traded at a price-to-earnings ratio 815 times the industry average, multiples that belong to speculative tech startups, not infrastructure firms. Adani Total Gas carried a debt-to-income ratio above 2,000%. 5 of 7 listed companies reportedly lacked assets to cover their debts. Yet the market kept climbing. So why wasn't it caught? Because in the ecosystem surrounding Adani, every incentive pointed in one direction, up. System failure analysis. The Adani case is a study in how systems designed to prevent fraud can be neutralized by proximity to power. India's Securities and Exchange Board, SEBI, was tasked with investigating the Hindenburg allegations. In August 2024, Hindenburg published follow-up research alleging that the SEBI chairperson herself had ties to offshore funds connected to the Adani Group. SEBI later cleared Adani of wrongdoing in 2 key cases, a decision that drew sharp criticism from opposition politicians and international observers. India's regulatory apparatus faced a structural conflict. The Adani Group was not just a corporation, it was the infrastructure arm of the Indian state, building ports, airports, and energy systems at the heart of the government's development agenda. Holding Adani accountable meant disrupting the very machinery powering the country's economic growth narrative. International investors also failed to push back. ESG-mandated funds poured money into Adani Green, drawn by its renewable energy profile, without scrutinizing the governance layer underneath. At one point, 500 ESG funds held Adani stock. Norway's largest pension fund was forced to dump its Adani Green holdings when it emerged that the company was using green energy stock as collateral for coal operations in Australia. Just days ago, in late February 2026, Norway's $1.2 trillion sovereign wealth fund, the world's largest, formally excluded Adani Green Energy from its portfolio over gross corruption concerns. The short seller who started the unraveling didn't survive the aftermath either. In January 2025, Nathan Anderson disbanded Hindenburg Research, citing the personal toll of the work. The firm that had identified what it called the largest corporate fraud in history closed its doors before the legal process reached a conclusion. Collapse. The collapse came in waves. The first hit on January 25, 2023, the day after Hindenburg published. $50 billion vanished from the Adani empire in 24 hours. Within 3 weeks, the total market capitalization loss exceeded $150 billion, dropping from $236 billion to $127 billion. Then came partial recovery. enough for the group to declare vindication. But the second wave, triggered by the U.S. indictment in November 2024, struck deeper. This time, it wasn't a short seller's opinion. It was a federal criminal charge. Adani Green's bond sale collapsed. Global banks including Credit Suisse and Citigroup stopped accepting Adani bonds as collateral. Morgan Stanley exited entirely. As of early 2026, further SEC proceedings are advancing, and Adani has agreed to accept legal service and respond within 90 days. Human cost retail investors in India, many first-time participants drawn in by the relentless rise, watched their savings evaporate. Pension funds in Europe and North America discovered their sustainable investments had been propping up alleged bribery schemes. 23,000 employees now work under a cloud of uncertainty. Opposition leader Rahul Gandhi declared, "Adani has hijacked India." Whether or not that holds legally, the erosion of public trust in the institutions meant to protect ordinary citizens is already real. Psychological autopsy. Adani's early success was genuine: real ports, real power plants, real infrastructure. But somewhere along the arc, ambition outpaced what legitimate growth could sustain. When your empire is intertwined with national identity, when your stock price becomes a proxy for an entire country's future, the pressure to keep, the numbers rising becomes existential. Each inflated valuation demands a higher one. Each undisclosed loan requires another layer of opacity. The fraud, if proven, wasn't born from a single decision. It was the accumulation of small compromises that became impossible to walk back. Reflective ending. The Adani story isn't just about one man or one company. It's about the blind spots that form when economic ambition and political power converge. Regulators deferred because the empire was too useful. Investors deferred because the returns were too attractive. And the public deferred because the narrative, a self-made man building a nation, was too compelling to question. The most dangerous frauds aren't the ones that look suspicious from the outside. They're the ones that look like exactly what everyone wants to believe. The infrastructure was real. The growth was real. But the question that remains is how much of the foundation was built on trust that was never earned, only manufactured. That distinction between trust earned and trust manufactured may be the most important financial lesson of this decade.